Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I'm the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a former macroeconomist, and I currently serve as a certified financial planner and wealth advisor. Now, today I had the distinct pleasure of interviewing Dr. Charles Calomiris. Now, Dr. Calomiris, if you haven't heard of him, is a world-renowned banking and financial expert. He's even testified before Congress on matters of banking and financial regulation. He is I would say, one of the best scholars when it comes to understanding the financial crisis. If I had to handpick anyone to come on this podcast to really help you as a listener actually get to the heart of what happened during the 2008-2009 financial crisis, Dr. Calomiris is definitely at the top of the list. A couple things to note about him. He is Professor Emeritus from Columbia University. He holds a BA in economics from Yale, as well as a PhD in economics from Stanford. He's written exhaustively on the banking crisis. I call it the banking crisis because I think the financial crisis of 2008-2009 was really predicated on a banking crisis. But he's really an expert on those episodes, and he's written a lot about the history of banking crises. In fact, we're going to address his book today, Fragile by Design, that he co-authored. All right, so this is the second part of my interview with Charles. This is part 4 of the financial crisis series. Now that you have a broader understanding of the history of banking and the history of banking crises, for instance, the United States, as you now know, is prone to these systemic banking crises. Now, the narrative you're going to hear, and you've probably heard over and over again about the 2008 and 2009 financial crisis, is that it was an aberration. It was a crisis that was led by just recklessness and pure raw greed. But I've always found that story to be very dissatisfactory. And now that you've learned from last week that banking crises are not an aberration in the United States, but frankly par for the course, today Charles is going to get into the deeper, much more complex, much richer story behind why the United States actually tumbled into this terrible crisis in 2008 and 2009. You'll actually understand the reasons behind all of this. I hope you enjoy. That's right. That's, I think, the wild part of this. So let's get into the Great Recession. And thank you, Charles, for a great explanation of and it was brief. Obviously, your book is way more exhaustive, and I would encourage listeners to go out and buy the book, Fragile by Design. Let's talk about the financial crisis. The stage is set, and now we're going to get into largely the 90s. I think we still need to touch even, back to the 70s with the Community Reinvestment Act. But the narrative about the financial crisis, again, another popular narrative, is that people just inherently got super greedy, and because of the wealth of the nation and the power of the nation and the strength of the financial institutions, it was just a bunch of greedy people, and they lost their minds, and it was madness, and the financial system collapsed. That is actually a pretty common explanation. Right. If you watch most Wall Street movies about the crisis, I've watched them all. To my knowledge, I've watched them all. I've read several of the books like The Big Short and Too Big to Fail. Both books actually were quite enlightening. But one of the things that I think is missed is there is still, particularly in the movie renditions of those books, which take it in a slightly different way, there is this persistent, ongoing narrative that this is the problem of capitalism. People get greedy, and when you get too much money, the system blows up. But I don't think that's the story. So what do you say when people say that the crisis was predicated solely on greed?
Well, I mean, it's not a satisfying explanation that people suddenly became greedy and didn't become greedy at other times and didn't become greedy in other countries. So if you think like an economist, an empirical economist, you think the world is a big place and time is a pretty long thing too. And so when we're trying to understand financial crisis, I have a new book that I'm working on with Matt Jaremski, a professor at Utah State, on the history of financial crises, not just banking crises. And
Oh,
we are
cool.
looking at this notion of greed and fear. So the other view is greed and fear occurs in some regularly repeating cycle, okay?
Hmm.
That view does not work very well as an actual theory that can be taken to the data of all of world history, as we'll show in our book. It doesn't mean that there aren't some moments when people seem to be behaving somewhat irrationally and prompted by fear or greed. I'm not saying that that never happens. Of course, I'm a human being. I'm subject to that
Sure.
too. This does happen occasionally, but we think that this is not a general theory that can explain things. When we're looking, and also fear and greed are prompted typically by the environment that makes them seem like a good idea, right? So if the
And well,
government,
there's incentives. There's
right,
incentives put in
that's the
place that
point. So
that's what
yes,
changes, and that's why people get greedy.
so if you say, yesterday I required you to put down 5%, which is, by the way, way too small, of your own money for a down payment, and I also required you to go through a credit check. That's how you got a house a few years ago. But today, I changed the rule. You don't need any down payment, and there's not going to be any credit check. Then guess what?
It's crazy.
You get a lot of people who might be willing to think of a house as just a kind of gamble, right? So
Hmm.
I lie about the fact that I have a good, well-paying job because I know there's no credit check. That's called a liar loan. And I don't put any of my own money down, and I hope that I'll get a job and that prices will keep going up. And even if I have to sell my house, I'll be able to sell it at a profit, or I'll be
And
able to
real
get a
estate never
mortgage.
goes down.
Well,
Charles, real estate never goes down in value too. So remember that.
well, that was seemed. I could go into each of these things and explain the kernel of truth to why people were thinking that way, even though it was wrong. Why they were thinking that way, the things that prompted it. But what we tried to do in the book, in discussing this, is to explain how the subsidies, the government subsidies, were pointing everyone in this direction. And
That's
that's,
right.
I think, the dominant story. But there's another story, too, which was monetary policy was also extremely loose. And
Yes.
what we know from universally from studies of monetary policy is that when monetary policy is loose, for a variety of reasons that economic theory has identified, it tends to make the price of risk smaller. It's not obvious why that should happen, but it does. So that
Hmm.
when interest rates are very low or monetary policy is trying to goose the economy, one of the main things that happens that helps to goose the economy is the price of risk falls. So for example, what would be an example of this? The spread between a triple B bond and a triple A bond gets more narrow when monetary policy gets loose.
Hmm.
Um, the the implied volatility, the VIX or other such things, gets lower when monetary policy is loose.
Hmm.
People's perceptions of risk and the market pricing of risk is reduced. So we really, there was a sense of a perfect storm because we had a political decision to subsidize housing risk by doing these crazy, zero down payment and liar
Ninja
loans,
loans.
right? All being pushed through the secondary mortgage market, Fannie and Freddie, in combination. So it's a complicated story having to do with banks originating activities which were prompted by the Community Reinvestment Act provisions, but in conjunction with the GSE Act of 1992. And then this is setting the stage for this big shift in uh, lending that's promoting very high risk taking in the residential real estate market, but then also this across the board effect coming from loose monetary policy, and they are coinciding from basically at their worst from 2003 to 2007. And so we had this extremely loose monetary policy from 2003 to 2006, and we had this incredibly loose lack of risk management in the mortgage market. And I want to emphasize, although we may not have time to talk about all the elements of that mortgage risk, but I want to emphasize that from a political standpoint, what this reflected was a shift of power from rural areas to cities. So the coalition of politicians that was in favor of subsidizing mortgage risk, which gave us more mortgage risk, was the entire Democratic Party and all of the urban Republican Party and all of the candidates for president of the United States, because they all needed Ohio and Florida and some other states if you were a Republican presidential candidate. And the only way you get those is if the major cities in those states were behind you. And the only way you'd get that is if you were doing things that were considered good by urban residents in those cities. So this shift of population to urban areas caused a dramatic political shift in favor of mortgage risk subsidization. And that is what drove the political decisions. Okay, so I'm not going to, although I don't have time to go through all of that, I do want to just show your readers how facts that they're not aware of can turn out to be very important. It became clear in the 1990s, certainly by 1992, but long before then, in the 1980s, that banks were now going to be merging. There was going to be this consolidation and this nationwide bank, right? It became clear. As that became clear, believe it or not, people in Washington, in the political circles, like the Senate Banking Committee, figured out that they could create a need for merging banks to have to appear before the Federal Reserve Board in Washington and justify themselves as good citizens. So that the way you can, when you apply to do an acquisition of another bank as part of completing this merger process, you had to, number one, demonstrate that you weren't creating a monopoly in the deposit market. And the number two thing you had to demonstrate is that you're a good citizen. How do you do that? Well, you bring in community activist groups in the area where you're going to be acquiring this bank to testify, to say how much they love you and want you to be the bank that acquires them. And that's the whole thing. That's the whole hearing. How do they know you're a good citizen? Well, Drew, it's not hard. They know what a good citizen you are because you gave them a lot of money. How much money did the banks give those activist groups?
Like Acorn, by the way.
Like Acorn. How much did they give them? And in what form? They gave them $2.5 trillion.
Wow.
From 1992 to 2007.
Wow.
And 90% of that was in targeted mortgage credit assistance to the members of the group. So how do you become a member of the group? You go to protests. You attend protests, you carry signs, you do things that the group leader wants you to do, and then you get to have a cheap mortgage. The other 10% was direct cash given to the organizations. So these were part of written agreements, typically with a 10-year length, that were signed before the people like Jesse Jackson or Al Sharpton or whoever else would actually go to the Federal Reserve Board and testify in favor of the merger. They actually had a signed 10-year agreement.
So this is the new coalition. This is the new banking coalition.
Exactly.
This replaces the agrarian populist coalition.
But I also want to point out, so George H.W. Bush signed the GSE Act. George W. Bush was a fervent proponent and advocate of it. Newt Gingrich was all behind it. So It's not just the Democrats.
Nope.
It's all those people too. Who's against it? Who's against it? Well, the Phil Grahams of the world, or the James Bakers or Howard Baker, I forget which it was, the guy from Louisiana. So if you were part of that old now losing rural coalition, you were against this whole racket. But you were you were just part of one of the political parties. You weren't, it wasn't the whole Republican Party. And so you were in the losing position. The population shift, the technological shift, along with the distress of the 1980s that hit all those banks, combined to push in this direction. But it created the outcome, the political outcome was the GSE Act, these court cases, these hearings before the Federal Reserve Board, and $2.5 trillion of contract. These are thick documents. And there was an organization called the NCRC that actually wrote manuals for the community activist groups to read about how they could bargain to do sort of maximal extortion as part of their negotiations with these merging banks. And I want to also point out the Federal Reserve Board was keenly aware of these documents. Instead of objecting to these documents as kind of like creating conflict of interest and we shouldn't be able to rely on these groups, instead they welcomed it because they knew that Congress had people that would have really been angry at them if they had tried to stand in the way of this. And the Federal Reserve Board was so keen to preserve its control over monetary policy that it basically turned a blind eye to this incredibly corrupt and risk-increasing process. It was really a disgraceful episode from, roughly speaking, the whole merger wave was this disgraceful episode of extortion and political influence peddling and creating purposefully risk. And it's not something that the Federal Reserve will ever own. It's not something that the activist groups will ever own, or that Newt Gingrich or George W. Bush will ever own, or Bill Clinton, who really invented it. So that's part of our national history. And understanding where the risk came from is very much about, it's not all about this. It's also about monetary policy during that period. And
Agreed.
So I'm not saying that there's just one story, but this is a big contributor to it. If it hadn't been for this, the crisis wouldn't have happened.
I've always contended that there were kind of three parts of this: deposit insurance, the affordable housing push from the Fannies, the Freddies, just the pressure to lend to, it sounded good, like let's just lend to poor individuals and communities, but really we were preying on those poor people by giving them mortgages that they frankly ever could afford, and especially when rates go up on the teaser loans, then they lost their home. And then the third piece I've always contended was excessively loose monetary policy. I'll posit a theory, by the way, on why I think it can lead to excessive risk taking. I'm a business, right? If I borrow at ultra low rates, let's say I borrow at 5%, my expectations are set at lower rates. So my perception of risk is anchored. It's the anchoring bias. My perception is anchored at this ultra low rate. And so I'm going to take risk commensurate to that interest rate level. When the Fed then has to, after a loose cycle, when the Fed then had to start to raise rates, I think it started around 2006 when they started raising rates, 2005, 2006, when they started to raise rates. Now all of a sudden, my costs to service my debt go up. The risks that I was willing to take that are anchored at artificially low rates get exposed, and now I start to suffer losses as a business. What do you think of that theory of how that could increase risk in the system?
I mean, I can't refute that theory. We have a lot of theories that sound similar to that I've heard. There are other theories too that are more grounded in what we call general equilibrium economics, wealth effects, and other things. So what's really interesting about this phenomenon, again, the basic phenomenon is when monetary policy is loose, when interest rates are low, spreads tend to also get very low, get very tight. We can explain them in a variety of ways. Another way to understand it, which is kind of related to what you're saying, is suppose I'm an investor and interest rates are real low. I might be kind of hungry for a little yield. And so that means I'm willing to take more risk than I normally would. And that bids those credit spreads down. which is kind
I
of
do with
related.
this as an advisor. I do with
Yeah.
this as an advisor where when we were in ultra low rates, clients would come to me and say,
Right.
I'm not okay with
Right.
3% income off
So
of,
I have a
off
lot
of
of
a bond
evidence.
fund.
Yeah, there's a lot of evidence.
And I have to
consistently.
temper them, Charles. I was like, look, I know that this high yield fund, we can do a sliver into your portfolio. But if you think we're going to put in 8% yielding high yield bonds as the core holding
Right.
of your fixed income portfolio, just know that in '08, that same strategy was down 35%. So, but people don't always calculate that risk, Charles. They just
I've
don't.
looked at bond funds globally, and I can tell you that before the era of low interest rates, there was we had a lot more of these global funds that avoided high risk emerging market, for example. And then
Sure.
when the interest rates fell, they did what you said. They added a sliver of emerging markets. So it had been prior to that it was emerging market specialist funds only that were holding the emerging market stuff. And when the interest rates environment got very low, you saw
Yield chase.
the general high investment grade funds wanted 5% of emerging markets because it really boosted their spreads.
Well, and I've seen this happen with what are deemed investment grade bond funds. And as long as you hold 80% in investment grade bonds, then you're still considered a high quality fund. It's interesting watching, and I watch what these managers do. It's interesting watching some of them creep all the way up to the 20%. And then I'll look at other managers and I'm like, oh, interesting. You're at 7 or 6%. And those are funds that I prefer in an environment like today because I realize, okay, they're not chasing yield unnecessarily to entice new investors. Yeah. They're trying to be prudent by nature.
Exactly. Yeah. No, I think if it's your own money, you're not playing this game. Or at least if you're smart and it's your own money, you're not playing this game. And you're also aware of credit cycles. You're aware that at the time when these things tend to be cheapest, it's just before things kind of blow up in your face because the cheapness is driven by something that's about to change, namely the low interest rate, right?
That's right.
It doesn't really make a whole lot of sense to play this game because it's going to revert. And when it reverts, your small spread's going to get large, which means you're going to have a capital loss. So
correct.
It doesn't really make a lot of sense. But I guess, this is one of the big surprises that's happened to me. I've been a professor, an academic for over 40 years now. When I got into this business as a PhD student, I really thought I was going to be explaining how economic efficiency is a guiding light that drives human behavior. And what have we been talking about here in this interview? Well, first of all, there's this thing called politics. But the other thing is there's this thing called investor behavior that's not always as wise as we would like it to be, too. And unfortunately, when things really go wrong, it's when these two things tend to coincide. The politics creates incentives, or the monetary policy creates incentives, and then behavior jumps on that. And, it's really sad to think how many people were harmed by the crisis of 2008, especially poor people who jumped on to these seemingly, amazing possibilities of having houses. But then those turned out to be houses they couldn't afford, that they couldn't keep. So that the people who were most harmed by this were the people who were being used to justify these policies by these urban activist groups. I don't think that their constituents were really made better off by this. But we could say there's a deeper point here, which is the poverty mafia in the United States. They all seem to keep getting richer.
They sure did. It was a cartel, for sure. Let's talk about the GSEs. So let's talk about Fannie and Freddie and the level of risk that they were ramping up. And I'd like to get into the mortgage-backed securitization phenomenon, the collateralized debt obligation. And are you still okay on a little bit more time to wrap this up?
Yeah, sure.
Okay. Let's talk about the GSEs. So what were Fannie and Freddie particularly doing in your estimation? Like, explain the risks that they were taking.
Okay,
Charles.
so the 1992 GSE Act required the GSEs to meet quotas that were established by HUD that were growing over time. This was Bill Clinton's idea. And that even though it was signed, the growth of it was Bill Clinton's idea. It was initially signed by George H.W. Bush. These growing quotas would tell the GSEs, that's Fannie Mae and Freddie Mac, how much they had to purchase of low income and inner city kinds of mortgages. And so they had various categories of mortgages of these types that they had to buy. And it was a growing percentage over time. It grew to be a very large amount. Yeah. We know how they reacted to this because I had access to Freddie Mac's emails from their risk managers to their CEO when I testified about this before Congress. And it was clear that the risk managers in 2003 and 2004 were calling out the fact that the increasing, the deterioration of the credit risk management was a real problem. And what happened was the CEOs couldn't meet their HUD standards except by relaxing the credit standards. Because as you go further and further into this wave, you had to search harder and harder to find more low-income and inner-city mortgages so that you met
because of political pressure.
Right, because of the quotas. The quotas were rising. And so the way you do that is you reduce the documentation requirements. So in 2004, the risk managers at Freddie Mac were in full rebellion. They said, we know from having experimented with different documentation requirements in the 1980s, we know what will happen if we eliminate all of these documentation limits. That led, and he sent a very long, there were several risk managers, they were all in agreement, but one guy laid it all out in gory detail. He got fired and then became a middle school math teacher. And it was absolutely clear that they were doing this. Now, I want to emphasize something about this. This made the crisis for the whole country, because what Freddie Mac and Fannie Mae did was they said, there is no risk to getting rid of documentation requirements, and there is no risk to getting rid of down payment requirements. And since they felt like they couldn't say, we're eliminating these requirements only for the inner city and low income housing, because then it would have drawn attention to the fact that they were making a risk choice. Instead, they had to argue, and did argue, that there was no increased risk, and therefore they did it across the board. And so so even though it was driven by the HUD requirements, the deteriorating credit standards applied across the board. This is a hugely important point, that they couldn't say, we're going to meet it for just these borrowers, and we're going to target only that group with these diminished requirements. They couldn't, because then that would have called out their lie. That would have shown that they were taking risks. They didn't want to do that. From the standpoint of their stockholders and from the standpoint of their stock price, they wanted to hide their risk. And they actually were committing accounting fraud about what the riskiness was of their mortgage portfolio. They at least one of them reached a settlement with the SEC relating to that accounting fraud afterwards. So these are all things that are kind of kept hidden from the American people of the way this worked. And the reason that this was so effective is the guy who invented this realized that if the banks, when they're entering into those agreements with the activist groups, knew that they could unload a lot of their bad mortgages on the GSEs, they would be more generous in their agreements. That was part of the specific calculation of the people who designed the 1992 GSE Act. I want to be clear. Many people don't understand how our government works. I know the guy. He's very proud of this. He thought of this in 1992. You have to give him some credit.
Wow.
He thought of how this would help make the signed agreements between the merging banks and the activist groups more generous. So when we think about these things, it's not all just folly. It's not just human folly. It's maybe misguided because this caused a lot of people a lot of harm. I'm sure he's sorry that happened. But this was his intention. He was a staff member of the Senate Banking Committee.
Wow. So my understanding, too, is that Freddie in particular, I guess both Fannie and Freddie, were buying up the mortgage-backed securities as well, right? So they're taking all these mortgages, they're packaging them, they're securitizing them, and then...
So there's purchasing and there's guaranteeing. They do both of those. The quotas apply to the purchase portfolio of Fannie and Freddie. Go on.
Okay. So... Because one of the things that I kept thinking about is, so how did the commercial banks get tied into this, right? Like, what incentive did they have to take on all this excessive risk? And one of my understandings is that, and by the way, a few banks that did well, and I've always applauded them. J.P. Morgan, I always thought Jamie Dimon was a relatively prudent banker. I've read a lot about him and how he handled things. He was very cautious through I know he didn't get entangled in the long-term cap management scandal like others did. He was a cautious, prudent banker. He called out mortgage-backed securitization and some of its inherent flaws in the early 2000s. He was made fun of, by the way, for that. Right. Goldman Sachs didn't get tied up into this, but a lot of investment banks did. You had Lehman Brothers. You had Bear Stearns, Morgan Stanley, Merrill Lynch, right?
So
how did they get entangled?
That's a great question. So I want to first... To answer that, you have to understand the way the whole intermediation apparatus of mortgage-backed credit worked involved several intermediaries. For example, insurance companies that would insure the portfolios, so-called monoline insurers.
AIG, were they doing this?
Yes. Then but they weren't a monoline company. So the monolines are only people who are insuring these portfolios.
Okay, sorry.
Then there's also the ratings agencies. And so if you look at how the academic literature evolved, people have kind of looked at each one of these things to try to understand what's going on with the rating agencies. They're rating these portfolios in a crazy way. They're assuming that during a recession, housing prices don't go down. Well, that's because they only have a 10-year look back, and the only recession that they were looking at was one in which real estate prices didn't go down. Were they doing that on purpose? Yes, because I called them out on it before the crisis at a conference, and I said, your model is crazy.
10 years?
Yeah, they did a 10-year.
Could you imagine running a model like that, Charles? Could you even fathom?
The only recession they looked at was the one in which real estate values didn't go down. Furthermore, they had nothing in their model that tried to take account of these exotic features like liar loans or other things. So their model basically said none of these things mattered. And so you looked at it, it was just clearly dishonest. If you talk to people, they'd say, well, if I don't do that, then I don't get paid to do ratings because somebody else will do it. So the ratings agencies were competing for this business. And then you have to ask, well, why were the originators able to get away with that? Because didn't the people who were buying the mortgage-backed securities care about the ratings? The answer is no. The people buying them knew what the risks were, but they benefited by having the risks considered higher because from a regulatory standpoint, the ratings could limit what risks you could take. But you don't care. As long as you know what the risk is, you want everything to be rated very highly so there's no regulatory limit on what you're doing. So the constituency for honesty was non-existent. And you saw all the elements like real estate brokers that were legitimate were exiting. Fly-by-nights were entering. Ratings agencies were changing their behavior. But to give you an idea of how far back this goes, I think this is a great fact. A corporate bond with a triple B minus rating should have a default of sort of 5-year default risk of about 2%. 2%, right?
Yep.
a physical default risk. In December 2005, the triple B mortgage-backed securities that were part of the CDO, I think I'm trying to remember if it was CDOs. Anyway, they had, this is in December 2005. This is not 2008, right? December 2005 had a physical
Correct.
default rate of 20%.
It's junk bond category.
Much worse. I mean, horrible.
It's worse than junk bonds.
20%.
Yeah.
Not 2%, 20%. So the people who were investing in these knew that the ratings were meaningless, and
They were fake.
They knew that triple B meant 20% risk. How did they know that? Because they had already experienced it. It's not that. So there is no like honest mistake here on the part of institutional investors. So yes, people were taking risks. They thought they were in a game where the prices kept going up. I think there was some behavior, some sort of crazy behavior. But the thing that drove the bus was the unprecedented subsidization of mortgage risk through the combination of the GSE Act and the Community Reinvestment Act. And it wasn't that the Community Reinvestment Act would have done this by itself, nor could the GSE Act have done it by itself entirely. It was the combination of the two. And then all of these other mortgage intermediaries kind of jumped on the bandwagon, the ratings agencies and the investment banks, and they were making huge fees from it.
Yep.
And it was I think it was pretty clear. I will tell you, I was a commercial banker, involved in a commercial bank, and I told my loan officers they weren't allowed to make any more condominium loans in Washington, D.C. starting in 2003 because so to me, this was one of the most transparent and slow motion train wrecks in American financial history. I don't think it was one in which people shouldn't have been able to see it coming. But, you didn't know exactly when it was going to collapse, and you could make a lot of money for the next 3 months or the next 4 months or the next 6 months if it went a little bit longer. And so I think that this is part of what's going on, but that doesn't absolve the government of the responsibility, nor does it absolve the Federal Reserve of the responsibility for the loose monetary policy. So we want to make sure that we pay attention as citizens to what's going on in our country so that we can try to create a change. I'm not very optimistic about that, but I would just say, we have to at least learn these facts so we don't just believe these superficial stories about, we all got greedy. That's what happened. Ridiculous.
Yeah. It is ridiculous. One of the really fascinating parts of this, and I'm curious on your perspective on this, is I'm generally a proponent of financial innovation. I like to see financial innovation. I like to see change. But when financial innovation becomes predicated on what I would just say is very poor incentive structures that you just laid out, you look at the mortgage-backed security, which then morphed into the collateralized debt obligation, which is like a package of these things. And then you get the synthetic mortgage, the synthetic CDO, right? Which is basically just levering and gambling. It's like a bet upon a bet. And my understanding is that the amount of outstanding mortgages, the amount of securitization around real estate was like 5 times the actual underlying mortgages. So question to you, had we not engaged in wild speculative synthetic CDOs and just even traditional CDOs, had it not ballooned way beyond even the available amount of mortgages, do you think the crisis would have been significantly more contained? Did that throw kerosene on the fire?
I don't think so. I think a lot of this sort of derivative focus on derivatives and securities on securities, I don't really believe that was.
That's
I think
not the issue.
It's a symptom. But if Fannie and Freddie are holding subprime portfolios that in excess of $1 trillion worth of mortgages, and that's going to have an effect. If if commercial banks are paying activist groups by giving them $2.5 trillion worth of subsidized mortgages, it's going to have an effect. So I think the financial innovation certainly is symptomatic of what was happening. But the driver of the bus was this subsidization of risk through this combination of GSE and banking policies having to do with the merger wave and the monetary policy. And it just seems like this is pretty clear to me. I can't imagine that somebody would say that those policies would have no effect. So yeah, the financial innovations, I think on the margin, are an interesting phenomenon. It's a symptom, but I don't think it's not a central part of the story to me.
Interesting. I appreciate that perspective. One of the last questions I have for you is really just the failure of regulations and capital requirements.
Yes. Oh yeah.
So
they had to fail.
Touch on.
So it's an equilibrium. So whenever you're sitting down and trying to figure out, you know those little paintings where you have to find Waldo or you have to find the pony in the picture.
Yeah.
So when you're trying to understand what makes the system unstable, you formulate this hypothesis about what the bargain is. And, it started in the U.S. with a rural bargain. It morphed into an urban bargain because of shifts in political power. But then when you say, okay, now how do I understand bank regulation? And you're a fool if you say bank regulation is independently formulated by well-meaning people. What you want to say is, how does bank regulation get politically determined so that it's consistent with the equilibrium? Mm-hmm. So imagine if bank regulation in 2006 had said, we're going to accurately rate the riskiness of banks' assets and then make them maintain capital according to that risk. Well, that would have undermined all of the stuff we were doing in our political deal.
They couldn't. So, to your point, they couldn't.
So you can't. So the regulator is politically part of the same equilibrium that's deciding the deal. And so, but I've worked in a regulatory agency. I've been involved in this my whole career. To pretend that somehow regulation is just this other independent thing being done by well-meaning people is ridiculous. Yeah, so, it is ridiculous. Of course, the bank capital regulation, the GSE capital regulation, and the bank capital regulation, which could have prevented, if you're creating these subsidies, then what would have happened? Well, you would have had to maintain more capital in recognition of the risks you were creating. More equity capital, both for the GSEs and for the banks. But then that would have taken away all the incentive to create the risk. And so then they can't do that. So the failure of prudential regulation is a predictable piece of the political equilibrium to subsidize risk.
What about deposit insurance? What role did that play in increasing risk during this crisis? And did it play a role to some extent at the other points that you've made?
I would say small, because the main risk takers at the time that they were taking the risk from 2000 till 2007, main risk takers were large banks, not small banks, and large banks that were very well capitalized. So that deposit insurance tends to matter more for small banks and more for banks that are undercapitalized. But the interesting thing is when Citibank is taking this risk, Citibank has very high amounts of market value of its capital. So it's not like this resurrection risk taking that I was talking about in the 1980s. So I tend to put a small weight on deposit insurance. On the other hand, what the big banks did know is they had too big to fail. So I would say it wasn't so much deposit insurance that was the moral hazard, but it was the moral hazard of too big to fail. Because remember, let's see, I'm going to play a game with you and your listeners. What assistance did Citibank and Bank of America get from the U.S. government? It's true that they got Federal Reserve assistance, like all the banks
That's right.
did,
TARP.
but they got TARP. And TARP, for most of the banks that received it, was just preferred stock investment. But for Citibank, once it became clear that that wasn't enough, they also got common equity investment. The government bailed out Citibank and Bank of America by making common equity investments available. That's very important to remember. In other words, if you can see, if I want to say Drew's too big to fail, how do I know? Well, the first thing I do is he starts to get into trouble. I give him Fed assistance, and he's enjoying deposit insurance, and then he says that's not enough. I need something that's more junior than that. I need assistance that's more junior. So I say, okay, I'm giving you preferred stock, and then you say that's not enough.
That's not good enough.
Because you still have to pay interest on that, right? Then I say, okay, I'm just going to have to be a common stock investor in your bank now. And so Citibank went down that road. So then the question is, well, did Citibank know that it was too big to fail? Well, of course, we've bailed out Citibank 3 times. I mean, this was just the 3rd time. So I think
and how much
moral hazard is definitely part of the story. The other thing that we learned during the crisis was the institutional investors were the more stock in your bank that was owned by institutional investors, the more they pressured you to take on this risk during the boom. So they actually, it seems like, I know this sounds far-fetched, but it almost seems like institutional investors knew that if things went sour, they would be protected by too big to fail, so they wouldn't have a complete loss. Let's note that Bear Stearns was bailed out. Stockholders were bailed out. So instead of ending up with nothing, they ended up with quite valuable stock because they were bailed out. So I think...
And Lehman Brothers wasn't, right? I mean, that's also fascinating. I think
the funny
Hank Paulson
thing
was afraid of moral hazard.
Yeah, but the funny thing was that when you look at what people at Lehman Brothers were saying, they actually were kind of thinking they would be bailed out because Bear Stearns.
Oh, of course they would.
Right. So
yeah, and then they bailed out Freddie Mac, right. and they're like, I can't believe they're going to bail out the GSEs and not. I mean, Dick Fuld was beside himself that they were bailing everyone else out but him.
So I think that I would agree with you that safety net was an issue. But for these large banks, it was the too big to fail that mattered more than the deposit insurance to their incentives during the boom.
I agree with that statement. And I think the blow up of long-term cap management, I think you referenced this in your book, that there was a study done showing that the major commercial banks that got tied in with lending to long-term cap management, which was, a hedge fund, that those same banks that were really intertwined and the Fed had to intervene to bail them out, those are the same banks that took excessive risk in 2008 and 2009. And the banks that weren't as tied in actually didn't take the same amount of risk. Am I right on what I read?
I think that's true. And yes, so it's really very interesting. If we do our sort of post-mortem analysis of this crisis, we do see some familiarities, let's say, from some of those previous episodes. And I can tell you, when I was at the Office of the Comptroller of the Currency as a chief economist and senior deputy comptroller, we knew, this was in 2020, we knew that Citibank was still the riskiest of the large banks by far.
So they're in the same boat still.
Relative to the other large banks, they remain the riskiest one. And I was an advocate for strengthening prudential regulation of Citibank. And I have to say, I find it very puzzling that was not done, except, of course, if politics might matter.
That's funny. It's an interesting theme that keeps coming up, Charles. Final thoughts here. I know. Go figure. So I thought we were all homo economicus, and that was the only thing driving the train here. So final thoughts here. And you've been beyond generous with your time, and it means the world to me. And I just thoroughly loved this entire conversation.
It's a pleasure talking to you, Drew.
Final thoughts. What is the state of the financial stability of the bigger banks? So we had 2022, where
Right.
banks like Silicon Valley Bank got caught in a duration trap. That seemed a little bit less terrifying to me, that they took duration risk as opposed to just buying junk bonds. What are your thoughts on the general stability of the banking system today?
Not good, not good. So there are about 600 banks that are on the verge of failure right now. Their fundamental risks are relating to interest rates and commercial real estate, which are themselves related. So if we get, let's say over the next couple of years, a big surge upward in interest rates, which I believe could easily happen,
Okay.
and I believe that will itself help to provoke a decline in commercial real estate. So my own view is over the next 5 years, interest rates will rise and commercial real estate will have a major problem, and that there will be at least 600, maybe a lot more, medium-sized and small banks that will experience huge losses relating to that. The large banks are also exposed, but not as much to those risks.
Right.
So I think we're in for a very rough ride. Banks are now commercial and residential real estate dominated in their risks, and especially for the small and mid-sized banks, that's a big problem. So there's a lot more to talk about. Unfortunately, there's going to be.
We don't.
I think within the next 5 years we will have a major problem there, and it's a scandal because using publicly available information, a team of top bank researchers at U.S. universities showed that this was true, and the Federal Reserve and the OCC and the FDIC have done almost nothing to require those banks to bolster their capital positions. So they just decided that they didn't want to. I guess they didn't want to suffer the downwards credit supply effects that would come from forcing those banks to bolster their positions. But that's another form of political decision, and we're now basically looking at several hundred banks likely to fail over the next 5 years.
You know, one of the stupidest things is the not forcing banks to market. You know, that's what happened to Silicon Valley Bank, right? They're predicating the value of their balance sheet on the maturity values, and these things have 5 to 10 years
it makes
left.
no sense. So, yeah,
It's
it makes
insane.
no sense.
It's insane.
It makes no sense.
I know
all.
that's not the only part of the story, but that is something
No,
that
it's a
is
big
always.
part.
It's really frustrating that
We
like
should
I
have
don't
learned
really
that
care
40
what the
years
value
ago.
of it is.
Yeah.
I know. I mean, this is basic finance. Charles, this has been an exceptional conversation.
Okay.
Thanks for
Thanks
coming
so
on.
much, Drew. It's my pleasure. I hope you and your listeners got something out of it. I certainly enjoyed it. Take care and
Me
have
too.
a great day.
You too.
All right. Bye-bye.
If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.